Did you know that while the vast majority of people are just completely struggling financially during global conflicts and crises, a really small minority actually grows their wealth?
Yeah, it's a stark reality.
Right. And I don't just mean like a temporary bump in their portfolio. I mean, they build real, generational, life-changing wealth during the exact moments when the rest of the world is basically paralyzed by fear.
Oh, absolutely. Everyone else is just watching the headlines and, liquidating their assets at the absolute worst possible time.
Exactly. So welcome to the deep dive. Today we are bringing you a very special Wealthnetic style deep dive.
Which I'm really excited about, honestly.
Me too. For you, the listener, our mission today is incredibly focused. We're going way beyond the doom scrolling, right? Beyond the sensationalist news cycles.
Because there's just so much of that right now.
So much. We want to uncover the actual hidden financial mechanics behind global crises. We're going to map out exactly how to protect and, yes, actually grow your portfolio during periods of extreme, headline-dominating volatility.
And I think we really need to establish the parameters of this conversation right away.
Yeah, good point.
The tone of our discussion today is not about, dwelling on the bleakness or the undeniable human tragedy of geopolitical conflict.
No, not at all.
Those are serious, devastating realities. But our mandate here is empowerment. We want to equip you with the macroeconomic education and the historical data necessary to navigate these incredibly turbulent waters with analytical clarity rather than emotional panic.
Right, we are essentially replacing fear with financial literacy. That's the Wealthnetic way.
Perfectly said.
Now, the insights we are synthesizing today, they're extracted from a highly popular financial strategy video that was originally broadcast in Asia.
Yeah, and it's been translated and heavily adapted for a global audience.
Exactly. And just to ensure everything is crystal clear for everyone listening, we've standardized all the underlying macroeconomic concepts and currencies to US dollars.
Which just makes the math so much easier to follow.
Definitely. The creator of this source material does just a remarkable job of breaking down complex market theories into these actionable steps.
They really do. They draw on a century of market data.
Right. And the candid statements of central bankers, plus the underlying philosophies of some of history's most legendary billionaire investors.
And you know what really stands out in the source material? It's the sheer predictability of these financial reactions.
Oh, it's almost scary how predictable it is.
It is. I mean, the specific countries involved in a conflict might change from decade to decade, but the movement of global capital, it follows this deeply ingrained historical script.
Yes.
And the very first page of that script always begins with the exact same catalyst.
Okay, let's unpack this. Because if we want to understand how to actually position our portfolios, we have to deeply understand the root cause of the market's reaction.
Right, it's a chain reaction.
Exactly. And the very first domino to fall, the catalyst that sets the entire global economy on edge, is energy.
It always comes back to energy. I mean, the geographic reality of modern conflict is just impossible to ignore.
Yeah.
If you map out the major geopolitical clashes over the last several decades, whether we were talking about historical tensions involving the U.S. or various flashpoints in the Middle East or ongoing conflicts in Eastern Europe.
Or even just skirmishes along major global shipping routes, right?
Exactly. These events, they rarely happen in a vacuum. They frequently occur in regions that are exceptionally rich in oil and natural gas.
Or they happen to sit right along the critical maritime choke points where that energy is transported to the rest of the world.
Right. It's the ultimate leverage. Energy is the baseline lifeblood of global commerce.
So during a geopolitical crisis, energy supply is basically immediately weaponized.
Yes. And the source material points to a very specific, immediate impact when these flashpoints ignite. Oil prices don't just drift upward.
No, they spike violently.
Exactly. We are talking about crude oil jumping from a baseline of, say, $60 or $70 a barrel straight up to over $100 a barrel.
Which is massive.
It's a 40 to 50% jump in a matter of weeks, sometimes literally days.
Wow. And we have to look at the underlying mechanism of that spike, right? Because it isn't always that the oil fields are physically destroyed.
No, or that the pipelines are immediately shut off.
Right. The spike is often driven by a massive surge in the uncertainty premium.
Yes, the commodities market operates on futures. It anticipates supply disruptions.
So if a critical shipping lane is threatened with blockades, or if a major oil-producing nation faces sanctions, the global market initiates a panic bid.
And let's not forget, modern militaries require unimaginable amounts of fuel to sustain operations.
Right, so global demand often surges at the exact precise moment that global supply feels the most precarious.
It's a perfect storm.
Okay, so we have a 50% spike in oil. Now, for our audience who already understands the basic concept of inflation, let's look at the secondary effects of this.
Because it's not just the gas pump.
Exactly. We aren't just talking about it costing more to fill up your car. We are talking about margin compression across the entire S&P 500.
Right, because energy is the baseline cost of production and logistics for literally every tangible good on the planet.
Everything. When the underlying cost of moving freight, operating manufacturing plants, and powering server farms jumps by 50%, corporations basically have two choices.
Right, they either eat the loss and destroy their profit margins.
Which they never do.
No, never. Or they pass that cost directly to the consumer.
And they almost always pass it on.
Always. And that is the transmission mechanism for crisis-driven inflation. It creates this macroeconomic environment where inflation acts as a ruthless financial treadmill.
Oh, I love that analogy from the video.
It's so good, right? Imagine you are on a treadmill running at a steady pace. That's your standard 2% target inflation.
Okay.
But an energy shock hits, and suddenly the belt speeds up to 5% or 8%.
Right.
Your legs, which represent your savings and stagnant wages, they're moving at the same pace, but you are being violently pulled backward.
Wow. Yeah, your purchasing power is just being actively eroded without you making a single poor financial decision.
Exactly, which forces the central banks into an absolute corner.
Because central bankers can't drill for oil, and they can't negotiate peace treaties.
Right. Their primary weapon against this runaway financial treadmill is a remarkably blunt instrument.
The interest rate.
The interest rate.
Yeah.
It is a blunt instrument, and deploying it comes with massive collateral damage.
Yeah, to fight the inflation caused by the energy shock, central banks are just forced to hike interest rates aggressively.
Making the cost of borrowing capital prohibitively expensive, their goal is literally demand destruction.
Right. If they make money expensive enough, businesses will stop expanding, consumers will stop spending, and prices will theoretically cool down.
Theoretically. But in doing so, they initiate the domino effect.
Right, and the source material outlines this in 3 distinct stages of economic impact.
Yes. The first stage, the immediate short-term fallout, is stagflation.
Ugh, the worst.
It really is. The economy stagnates, so you see hiring freezes, capital expenditures are slashed. But because the energy shock is still unresolved, inflation continues to burn hot.
It is essentially the worst of all possible macroeconomic worlds.
It is. Stagflation is notoriously difficult for policymakers to manage because the traditional remedies contradict each other.
Right. If you stimulate the economy to create jobs, you pour gasoline on the inflation fire.
Exactly. But if you hike rates further to kill inflation, you push the stagnant economy into a severe contraction.
And that contraction is the second stage, right? A global recession.
Yes. If the conflict drags on and the energy markets remain disrupted, this recession stage feels almost inevitable.
And it isn't isolated. It becomes a synchronized global slowdown.
Because everything is connected. The U.S. central bank hikes rates, the European banks follow suit to protect their currencies, Asian markets react.
And suddenly, the entire global corporate structure, which relies heavily on cheap debt to function, just hits a brick wall.
Yeah, the mathematics of corporate debt are completely unforgiving.
I mean, imagine a multinational corporation that routinely rolls over billions in short-term debt to fund operations.
Right, and suddenly they find that their interest expense has doubled or tripled.
The immediate reaction is to preserve cash.
Absolutely. They halt research and development, they execute mass layoffs, and they aggressively consolidate.
Meanwhile, the consumer is being squeezed by both higher credit card rates and that initial wave of energy-driven inflation.
So economic velocity just plummets.
And, the source doesn't shy away from the worst-case scenario either.
No, it gets pretty dark.
If the geopolitical conflict metastasizes, like if major shipping routes are permanently fractured or if critical supply chains are severed for years, that global recession deepens into a long-term depression.
A multi-year slump defined by structural unemployment and paralyzed capital markets.
Right. Now, obviously, the goal of a deep dive like this is to prepare for the worst while hoping for swift resolutions.
Exactly.
But it sets up a fascinating behavioral paradox. Let's talk about that.
Ah, yes. The safe haven paradox.
Right. Because if central banks are aggressively hiking interest rates to fight this stagflation, meaning I can suddenly walk into a major financial institution and buy a risk-free government bond yielding 5% better, why would any rational investor keep their capital exposed to the stock market during a war?
Right. It's a great question.
I mean, the risk premium on equities seems entirely unjustifiable when I can get a guaranteed 5% return just for sitting in cash or short-term treasuries.
And that is the exact calculus that drives institutional capital flows during the onset of a crisis.
Okay.
When the risk-free rate of return jumps to 5% or higher, the fundamental math of portfolio allocation changes overnight.
Right.
Think about a pension fund manager. They're looking at a volatile tech stock with an uncertain earnings future on one hand versus a sovereign bond offering a guaranteed yield on the other.
They're going to take the bond every time.
Every single time. They will rotate out of equities and into debt. And this rotation is why the stock market is almost always the very first asset class to hemorrhage capital when a conflict erupts.
It basically acts as the market's ATM.
Yes, stocks are incredibly liquid. I can liquidate a multi-million-dollar equity portfolio from my smartphone in milliseconds.
Right. But the sell-off isn't just about the mathematical rotation into high-yield bonds, is it?
No, it's fundamentally about human psychology.
Because equities run on the assumption of future growth.
Exactly. You buy a stock because you believe the macroeconomic environment of tomorrow will allow that company to be more profitable than it is today.
And war is the ultimate destroyer of future earnings visibility.
It introduces variables that literally no financial model can accurately price in.
Right, like supply chains might be bombed.
Consumer markets might be sanctioned.
Trade routes might be blockaded.
Yeah, and when that level of systemic pessimism enters the market, investors immediately project worst-case scenarios onto corporate balance sheets.
They assume widespread earnings contraction, and they sell aggressively today to avoid the perceived total losses of tomorrow.
Right. The equity bleed makes total logical sense when you look at it that way.
Okay, but here's where it gets really interesting. Let's challenge one of the oldest financial dogmas on the planet.
Let's do it.
For roughly 5,000 years, humanity's definitive safe haven during war, famine, and systemic collapse has been gold.
Right. When empires fall, people hoard physical gold.
Exactly. Yet the source material points out this glaring anomaly in recent history. During several major modern geopolitical crises, the price of gold has actually softened or dipped.
Yeah, it's fascinating.
Are you telling me that a temporary hike in American interest rates is enough to completely suppress a millennia-old human instinct to buy gold? That just feels like a massive historical anomaly.
No, it does feel super counterintuitive until you examine the mechanics of modern fiat currency hegemony.
Okay, break that down.
The source describes this dynamic as the seesaw effect.
It's seesaw effect.
Right. We are no longer living in an era where local merchants weigh physical gold coins. We live in a heavily financialized global system where gold is universally priced in US dollars.
Right.
And that measuring stick, the dollar, is highly dynamic.
So it's less about the metal losing its intrinsic value and more about the measuring stick getting artificially longer.
That is precisely the right way to visualize it.
Oh.
When the U.S. central bank aggressively hikes interest rates to combat the inflation we discussed, the yield on U.S. dollar-denominated assets becomes incredibly attractive to foreign capital.
Okay, yeah.
So if you are a sovereign wealth fund in the Middle East or an institutional investor in Europe or Asia, and you can secure a 5% risk-free yield simply by holding U.S. treasuries.
You are going to dump your local currency and aggressively buy U.S. dollars.
Exactly, because capital flows to wherever it is treated best.
And that massive global hoarding of the U.S. dollar creates a severe supply and demand imbalance in the foreign exchange markets.
Yes, the dollar strengthens like a fortress, and almost every other fiat currency on the planet weakens in relative terms.
That is the seesaw.
That's the seesaw. And here is where the seesaw crushes the price of gold.
Yeah.
Because gold is priced in those incredibly strong US dollars, the barrier to entry for the rest of the world skyrockets.
Oh, I see.
Imagine you are a retail investor in a country whose local currency has just depreciated 20% against the dollar due to this exact capital flight.
Right.
Even if the baseline price of gold in New York hasn't moved a single cent, gold just became 20% more expensive for you to purchase in your local currency.
You are literally being priced out of the safe haven by the exchange rate.
Yes. The purchasing power of non-U.S. buyers is basically decimated. And since global demand outside the U.S. makes up a massive percentage of the physical and paper gold market, that aggregate demand softens significantly.
People literally cannot afford the exchange rate penalty required to buy the safe haven.
Exactly. And when that global demand drops, the underlying dollar price of gold drifts lower. So in these specific modern macroeconomic setups, the ultimate safe haven hasn't actually been the precious metal. It has been the U.S. dollar itself.
That completely reframes how I look at precious metals during a crisis. It really highlights how intertwined every single asset class is with central bank policy.
It's all connected.
Now, what about the other traditional pillar of generational wealth? Real estate.
Real estate.
There is a deep psychological comfort in owning a tangible, physical asset that you can, touch and live inside.
Sure.
But the source material is surprisingly bearish on real estate as a liquid safe haven during acute global conflicts.
Yeah, because real estate is constrained by two very rigid, undeniable realities during a geopolitical crisis.
Okay, what's the first one?
The first is geographic immobility.
Right.
A luxury high-rise or a sprawling commercial complex is intrinsically tied to the sovereign stability of the land it sits on. If the conflict encroaches on that territory, the property's valuation effectively zeroes out. It cannot be moved, and it is impossible to liquidate in a collapsed local market.
Location takes on an existential rather than just commercial, meaning...
Perfectly said.
Okay, but let's play devil's advocate. Let's assume the real estate is safely half a world away from the kinetic conflict.
Right.
You are still dealing with the macroeconomic shockwaves, primarily the cost of capital.
Exactly. The capitalization rates of real estate are entirely beholden to the interest rate environment.
Right.
When central banks hike rates to fight crisis-driven inflation, mortgage rates naturally skyrocket.
Yeah, they do.
If the average borrowing cost for a commercial or residential property doubles over a 12-month period, the pool of qualified buyers shrinks dramatically.
The market just enters a deep freeze.
Yes. Sellers anchor to yesterday's high valuations and refuse to take a loss, while buyers are mathematically locked out by the cost of debt.
So while your property might look valuable on paper, true price discovery vanishes.
Exactly. It becomes an utterly illiquid asset precisely when you might need liquidity the most.
So if we step back, we are painting a remarkably hostile landscape here.
Very hostile.
Equities are hemorrhaging capital due to future earnings pessimism. Gold is being actively suppressed by the foreign exchange seesaw and a dominant U.S. dollar. Real estate is paralyzed by geographic risk and crippling mortgage rates.
Yeah, to the average observer, it looks like there's absolutely nowhere to hide.
But if we connect this to the bigger picture, turning to the premise of our deep dive, a specific minority uses these exact macroeconomic conditions to build massive wealth.
They do.
How are they navigating this minefield?
Well, to understand the mechanics of wealth preservation and expansion during a crisis, the source material pivots to a series of specific case studies.
Okay.
It examines the alternative assets and the contrarian philosophies that actually thrive when the traditional fiat and fiscal asset systems are under maximum stress.
And the first case study is this really visceral thought experiment that addresses the geographic immobility of traditional wealth.
Yeah, this one is powerful.
I want you, the listener, to actually visualize this scenario. Imagine you are a highly successful entrepreneur or a multimillionaire living in a region that rapidly destabilizes into a conflict zone.
Okay.
You have spent decades building a substantial net worth, but civil order is breaking down, borders are tightening, airspace is restricted, and you need to evacuate your family immediately.
It's terrifying.
How do you physically extract your wealth from a collapsing nation-state?
It is the ultimate stress test for capital, and it exposes the fatal flaw of physical assets, the portability dilemma.
Right.
Let's audit the traditional portfolio in this scenario. You own millions in commercial real estate, but as we just established, the local property market is frozen or actively being destroyed.
You cannot carry an office building across a border.
No. That wealth is effectively trapped and potentially lost forever.
Okay, what about the domestic banking system? You have millions in fiat currency sitting in highly reputable local banks.
Well, in a severe geopolitical crisis, the very first action a desperate government takes is implementing draconian capital controls.
They just freeze everything.
Exactly, the banks freeze. Withdrawals are halted to prevent capital flight, and the SWIFT network might be severed due to international sanctions. You cannot wire your money out.
And even if you manage to secure physical bundles of paper cash, the government is likely printing money around the clock to fund military operations.
Right. Your local currency is hyperinflating by the hour.
But by the time you cross the border, those millions in paper notes might possess the purchasing power of pocket change.
Exactly. Which is exactly why the traditional advice was always to hold physical gold.
But practically speaking, the logistics of gold in an evacuation scenario are a complete nightmare.
It's a logistical impossibility at scale. Let's just do the math.
Let's hear it.
If you want to transport $10 million in physical gold, you are attempting to move well over 100 kilograms, nearly 250 pounds of dense metal.
You cannot discreetly carry that through military checkpoints, across hostile borders, or onto an evacuation flight.
No, it makes you an immediate target for confiscation by state actors, or far worse, by opportunistic criminals. Your wealth becomes a physical liability that actually endangers your life.
And your stock portfolio isn't much better if your domestic brokerages are shuttered or if the regional exchanges halt trading indefinitely.
Right. You are a multimillionaire on a spreadsheet, but you are functionally destitute the moment you try to flee.
And this terrifying reality is exactly why the source material highlights the emergence of decentralized digital assets, specifically Bitcoin, as a revolutionary crisis hedge.
Yes. The source frames it as alternative digital gold.
Digital gold.
The defining characteristic of Bitcoin in this specific context is not its day-to-day price action against the dollar, but its absolute separation from physical geography and state control.
It completely solves the portability dilemma.
Entirely. Your net worth is not tied to a bank vault, a physical property, or a 100-kilogram stack of bullion. It is recorded on a globally distributed, decentralized ledger.
You don't need a bank's permission, and you don't need a cargo plane.
You literally only need your mind.
Wow.
By memorizing a 12 or 24-word cryptographic seed phrase, you can strip your wealth of its physical form, walk across a heavily guarded border with nothing but the clothes on your back, and rebuild your life on the other side of the world.
Because once you reach a safe jurisdiction, you use those memorized words to access your digital vault on the blockchain.
Exactly, and you can instantly liquidate that Bitcoin into the fiat currency of your new host nation.
It is an end run around collapsed domestic banking systems and authoritarian capital controls.
Yes.
Now, it is crucial to acknowledge, and the source material is very transparent about this, that Bitcoin and digital assets remain highly volatile.
Oh, extremely volatile. The price swings wildly.
Right. But in the context of this thought experiment, the volatility is a secondary concern.
Because if the choice is a volatile digital asset that you can actually retain custody of and transport globally versus a stable physical asset that is permanently trapped, confiscated, or destroyed.
The digital asset wins by default.
It has to. And this is no longer just theoretical posturing by technologists.
Right, we're seeing this happen.
The source data indicates that we are seeing this exact capital flight mechanism play out in real time during recent Eastern European and Middle Eastern conflicts.
High net worth individuals and everyday citizens alike are utilizing digital assets as a non-confiscatable insurance policy against geographic catastrophe.
It is a fundamental evolution in how humanity defines a safe haven.
That is a profound paradigm shift. But escaping a crisis with your capital intact is really only half the battle.
True.
If you are geographically safe, the next question isn't how to hide your money. It's when and how to deploy it into the market to capture that generational wealth. And the source material's second case study dives into historical market data to answer this, revealing a 100-year pattern that is completely counterintuitive to how human emotion works.
The data set analyzed here is incredibly robust. It tracks the performance of the US S&P 500, essentially the proxy for global equity health, going all the way back to 1926.
Wow, so almost a century.
Yeah. This encompasses the Great Depression, the entirety of World War II, the protracted tensions of the Cold War, the shock of the Gulf War, and multiple modern conflicts in the Middle East.
And the overarching takeaway challenges the instinct to wait for peace before investing.
Exactly. The axiom usually goes, buy when there is blood in the streets.
Right.
But the data refines that significantly. The market doesn't actually wait for the blood to dry.
No. In fact, historically, the most severe market drawdowns happen before the conflict officially begins.
And this is an absolutely vital psychological insight. The deepest, most violent market bleeding occurs during the war of words.
The war of words.
Yeah. It happens during the diplomatic breakdowns, the political posturing, the troop mobilizations on the border, and the endless speculative headlines.
Because the market is attempting to price in a nearly infinite matrix of unknown variables.
Exactly. Will an invasion happen? If it does, how expansive will it be? Will nuclear powers intervene? How will the energy supply chain react?
The human brain, and by extension the algorithmic and institutional brain of the stock market, is absolutely terrified of the unknown.
We can calculate and price in a known danger, but ambiguity causes panic selling.
Right.
But here is where the 100-year pattern emerges. Once the actual invasion commences, once the first kinetic actions occur, and the reality of the war is confirmed by the global media.
The uncertainty premium instantly evaporates.
Yes. The market suddenly knows exactly what parameters it is dealing with. The worst-case scenario transitions from a terrifying shadow in the dark to a measurable, quantifiable reality on a spreadsheet.
And historically, that precise moment, the outbreak of hostilities, is when the massive equity sell-offs exhaust themselves and the markets begin to establish a bottom and rise.
It happens almost every time.
That feels almost sociopathic on the part of the market. The day the tragedy truly begins is the day the financial algorithms start buying.
I know, it sounds awful, but it isn't morality. It's a mechanism of forward-looking discounting.
Okay.
The market is a discounting engine. Once the conflict begins, the market stops pricing in the fear of the invasion and immediately begins pricing in the massive wartime government spending, the eventual geopolitical resolution, and the post-war recovery.
And the source provides stunning numbers to back this up.
They really do.
If you look at the 100-year history of the major index, roughly 70% of the calendar years close positive, despite a century filled with relentless global trauma.
A 70-30 split favoring growth, yielding a historical average return of around 10% annually.
That's incredible.
And when you zoom in specifically on major conflicts, the data is even more compelling. The historical analysis shows that if an investor buys into broad market index funds on the very day a major geopolitical conflict breaks out and holds that position for a 1 to 4 year horizon,
they historically demonstrate average annualized gains of 8 to 11%.
let that sink in.
Yeah. The retail investors who let the 24-hour news cycle dictate their actions. The people who panicked and liquidated their retirement accounts during the war of words, they locked in permanent massive losses. But the minority, the investors who understood this 100-year macroeconomic pattern, who swallowed their fear and actively deployed capital when the invasion started, they captured an 8 to 11% compounded gain, riding the wave of wartime fiscal stimulus and eventual recovery.
Which brings us to the core philosophy of how to actually construct a portfolio that can execute that strategy.
Right, because you need a specific framework for evaluating assets.
Exactly. And the source material illustrates this using the investment playbook of one of the most successful, universally recognized billionaire investors of the modern era.
Now, we won't name him as per the source's rules, but his track record over the last 6 decades of market turbulence is effectively peerless.
Oh, absolutely peerless. And his entire crisis management philosophy is built around a brilliant metaphor, the oxygen analogy.
The oxygen analogy, I really like this one.
Me too. He argues that fiat cash is exactly like oxygen to a deep-sea diver.
Okay.
You absolutely must have enough of it in your tanks to survive the dive. If you run out of liquid cash during a macroeconomic shock, you suffocate.
Right. You miss your mortgage payments, your business defaults on its short-term loans, and you are forced into bankruptcy.
But, and this is the counterintuitive genius of his playbook, holding too much cash during a war is a guaranteed path to poverty.
Because of the inflation treadmill we dissected earlier.
Exactly. Geopolitical conflicts are astronomically expensive. Governments cannot fund sustained military campaigns purely through taxation. It would cause domestic revolts.
So they fund the war effort through aggressive deficit spending and the expansion of the money supply. They essentially print the capital they need.
And this massive dilution of the currency guarantees severe structural inflation.
Right. If you are hoarding millions of dollars in a checking account because you think it's safe from stock market volatility, that cash is actively losing its purchasing power by 5%, 8%, or 10% a year.
You are essentially paying a massive invisible tax for the illusion of safety.
So if having zero cash kills you instantly, but holding all your wealth in cash bleeds you dry over 5 years, where does this legendary investor deploy his billions during a crisis?
Well, he draws a very rigid, dogmatic line between non-productive assets and productive assets.
And this is the crux of his philosophy.
It is. He famously shuns physical gold, and he is a vocal critic of unbacked cryptocurrencies.
Okay, why?
His rationale is that they are intrinsically non-productive. A 400-ounce bar of gold can sit in a Zurich vault for 3 centuries.
Oh.
When you open the vault, it will still just be a 400-ounce bar of gold. It has no internal mechanism for creating value.
It doesn't manufacture a product.
It doesn't solve a human problem.
It doesn't pay a quarterly dividend.
Exactly. And it cannot raise prices to combat inflation.
Yeah.
Its entire valuation relies on the greater fool theory, the hope that someone else will be frightened enough by the macroeconomic environment to pay you more for that inert metal than you paid for it.
I can hear the gold bugs screaming at their speakers right now, honestly.
Oh, I'm sure they are.
But from a pure cash flow perspective, he's right. A non-productive asset is just a speculative vehicle. But a productive asset, that is a living, breathing economic engine.
Exactly. A productive asset is a high-quality business with a fortress balance sheet that manufactures essential goods, provides critical logistics, or develops vital software.
Right. It is a portfolio of prime agricultural land that yield crops every harvest.
Or it is commercial real estate in highly desirable conflict-free zones that commands monthly rental income.
And the superpower of a productive asset during a crisis is pricing power.
Yes, pricing power is everything. If energy inflation drives the cost of raw materials up by 10%, a dominant productive business doesn't just absorb the loss.
No. They adjust their supply chains, they optimize their workforce, and crucially, they raise the prices of their end products by 10% or 12% to protect their profit margins.
They adapt to the inflation treadmill.
Over a multi-decade horizon, this billionaire's thesis proves that owning equity in adaptable, cash-flowing enterprises will mathematically obliterate the returns of holding inert metal or fiat currency under a mattress.
So the overarching strategic playbook is secure enough liquid cash to survive the immediate, unpredictable shocks that is your oxygen supply.
Right.
But aggressively deploy the overwhelming majority of your capital into productive assets that generate tangible value for the global economy, regardless of who is currently occupying a specific geopolitical border.
Now, if we want to get incredibly granular for the listener, the source material doesn't just stop at buy good companies.
No, it goes deeper.
It highlights 3 specific sectors of productive assets that historically see massive influxes of capital and experience booming valuations precisely because of the dynamics of global conflict. Let's break those down.
Okay, the first naturally ties directly back to our initial catalyst, the energy sector.
Right.
When geopolitical tensions threaten global supply lines, the underlying commodity spikes, as we discussed. But the wealth isn't just in holding barrels of oil.
No, it's in owning the productive companies that extract, refine, transport, and distribute that energy.
Because their profit margins expand massively when the baseline price of the commodity surges.
And the source points to a fascinating data point regarding energy equity.
Yeah, this was really interesting.
During a recent period of intense geopolitical posturing and subsequent conflict, a major benchmark energy ETF, which tracks the largest energy companies in the U.S., saw a massive 22% surge in a single calendar year.
Wow. While the broader tech and consumer discretionary sectors were bleeding due to inflation fears, the energy sector was generating record free cash flow.
Owning the producers of the bottlenecked resource is essentially a masterclass in hedging against the inflation caused by that exact bottleneck.
Perfectly stated. The second sector highlighted by the source is the most direct beneficiary of conflict, defense and aerospace.
The mechanics here are brutal, but economically undeniable.
Yeah. The moment a major conflict erupts, the political calculus changes instantly. Sovereign governments that previously debated minor cuts to social spending suddenly authorize massive, practically unlimited emergency military budgets.
It's basically a blank check from the Treasury to the defense contractors.
Precisely. And the nature of modern warfare has shifted the capital allocation heavily toward advanced aerospace tech.
Right. We are no longer just funding traditional infantry battalions.
Governments are pouring hundreds of billions into advanced missile defense shields, autonomous drone swarms, and satellite surveillance infrastructure.
And the source cites staggering internal metrics here. Without naming the specific ticker symbols, they noted that leading aerospace contractors and specialized drone manufacturers experienced valuation spikes of 5% to 10% in a single month as geopolitical tensions escalated into kinetic action.
Yeah. The profit margins for these companies are effectively guaranteed by long-term government contracts that are entirely insulated from standard consumer recession fears.
Because a government will cut infrastructure spending long before it cuts funding for its own existential defense.
Exactly. That brings us to the third, and perhaps most structurally critical, booming sector, commodities and agriculture.
If energy is the lifeblood of the economy, agriculture is the literal lifeblood of the population.
Right, and food supply is frequently weaponized during conflicts, either through deliberate blockades or collateral damage to shipping infrastructure.
But the source material drills down deeper into the agricultural supply chain, specifically focusing on the producers of industrial fertilizers.
I found this part of the analysis fascinating.
Me too. We take global food abundance for granted, but it is a highly engineered, fragile system. Modern crop yields are entirely dependent on synthetic chemical fertilizers, specifically nitrogen, phosphorus, and potassium.
And here is where the geopolitics collide with agriculture. A massive percentage of the raw materials required for these fertilizers, like potash, are mined and processed in regions that are frequently at the epicenter of Eastern European conflicts.
Furthermore, the production of nitrogen-based fertilizers requires immense amounts of natural gas.
Right, so an energy shock inherently triggers a fertilizer shock.
When the supply chain for these critical inputs is severed by war or sanctions, the global cost of fertilizer skyrockets.
Which threatens global crop yields, driving up the cost of food commodities like wheat and corn.
And the companies that control the secure, non-conflict zone mines and production facilities for these fertilizers see their valuations explode because they possess a critical resource that the world is desperate for.
Exactly. The source also loops industrial metals into this category. Copper, nickel, aluminum. These are the building blocks of both military munitions and post-war infrastructure rebuilding.
Right. When supply lines tighten, the massive mining conglomerates that extract these metals experience incredible pricing power.
So we have covered a tremendous amount of macroeconomic terrain.
We really have. We've deconstructed the energy catalyst, the inflation treadmill, and the central bank's blunt interest rate response.
We've explored the seesaw effect suppressing gold, the geographic constraints of real estate, the portability revolution of digital assets,
The 100-year historical data on market bottoms, and the billionaire's philosophy of aggressively accumulating productive, cash-flowing assets in the defense, energy, and agricultural sectors.
but theory is useless without execution.
Right. So what does this all mean? This is a Wealthnetic deep dive, which means we cannot leave you drowning in macroeconomic data.
We have to synthesize everything we've discussed into a clear, empowering architectural blueprint for your personal finances.
Based on the deep analysis of the source material, we've distilled this down into 4 critical, actionable Wealthnetic steps to bulletproof your portfolio and position yourself alongside the minority who build wealth during crises.
Okay, let's get into it. Step number 1 is the absolute foundation of behavioral finance. Do not panic sell.
It sounds simple in a podcast, but it is the single most difficult directive to follow when the world feels like it is falling apart.
Because the entire modern media apparatus is engineered to break your psychological resolve.
Oh, totally. When a geopolitical crisis erupts, Your social media algorithms and the 24-hour cable news networks will inundate you with terrifying apocalyptic imagery.
They are financially incentivized to trigger your deepest fight-or-flight responses.
And if you allow that engineered digital anxiety to dictate your portfolio management, you will become a statistical casualty.
You will execute the exact losing trade we discussed earlier, liquidating your high-quality productive assets at the absolute bottom of the market during the peak of the war of words.
To inoculate yourself against panic selling, you must develop a profound, intrinsic understanding of what you actually own.
Right. If your portfolio is anchored by broad market index funds representing the top 500 corporations in the American economy, you are not holding speculative lottery tickets.
No. You hold fractional ownership in the most resilient, hyper-adaptable, relentlessly profitable economic engines ever created by humanity.
These corporate entities have successfully navigated 2 world wars, the Great Depression, the Cold War, the dot-com bubble, and a global pandemic.
They know how to survive and raise prices. Trust the historical resilience of productive assets.
Turn off the news feeds, step away from your brokerage app, and hold the line.
That is powerful. Okay, step number 2. Build a comprehensive 6 to 12-month oxygen fund.
This goes back directly to the billionaire's playbook. Cash is the oxygen that prevents financial suffocation during a shock.
We know that conflicts trigger energy spikes, which trigger rate hikes, which inevitably trigger corporate contraction and recessions.
And those high-level macroeconomic shifts eventually cascade down to the local economy in the form of hiring freezes, reduced overtime, and brutal corporate layoffs.
And we cannot view these geopolitical crises in a vacuum. The source material astutely points out that the modern worker is facing a compounding threat matrix.
Right. We are not just navigating the stagflation caused by overseas wars. We are simultaneously living through the most aggressive technological disruption since the Industrial Revolution.
The exponential advancement of AI and machine learning is actively hollowing out middle management and restructuring the white-collar labor market.
Entire job categories are facing obsolescence.
So the risk of temporary income loss is higher than it has been in decades. This is why a standard 3-month emergency fund is basically no longer sufficient.
No, you need 6 to 12 months of core living expenses parked in a highly liquid, easily accessible, high-yield savings account.
This is your oxygen mask. If the macroeconomic recession hits your sector, or if an AI deployment makes your current role redundant, this massive liquidity runway allows you to breathe.
It gives you the time to retrain, pivot your career, or relocate your family without ever being forced to liquidate your long-term equity portfolio at a devastating 30% loss just to pay your mortgage.
Exactly. Have the oxygen fund securely in place, but ruthlessly invest every dollar beyond that threshold into productive assets so the inflation treadmill doesn't quietly consume your wealth.
Which naturally bridges us to step number 3. Extend your time horizon and stay invested.
The human brain is evolutionarily wired to focus on immediate, near-term threats.
If you stare at a daily or weekly stock chart during the outbreak of a geopolitical conflict, it resembles the erratic, terrifying readout of a crashing heart monitor.
It literally induces vertigo.
The antidote to that volatility is to radically zoom out your perspective.
The source material challenges investors to conduct a simple 20-year retrospective. Think about the sheer volume of catastrophic headlines we have endured over the last 2 decades.
We have lived through the systemic near collapse of the global banking system in 2008. We have witnessed protracted, multi-trillion-dollar wars in the Middle East.
We endured a once-in-a-century global pandemic that literally shut down the global economy, followed by the most aggressive inflationary spike in 40 years.
By any metric, it has been an era defined by relentless crisis.
And yet, examine the valuations of high-quality assets today compared to that starting point 20 years ago. The broad market equity index funds.
Massively, exponentially higher.
Prime, cash-flowing commercial and residential real estate.
Significantly higher.
The alternative digital assets we discussed.
Astronomically higher. The empirical data is just indisputable. The long-term, secular trajectory of human productivity, innovation, and value creation is permanently up and to the right.
The crises, as terrifying as they feel in the moment, are ultimately just potholes on a multi-decade highway of economic expansion.
If you construct your portfolio with a 10, 20, or 30-year time horizon, the chaotic day-to-day or month-to-month volatility generated by geopolitical posturing becomes nothing more than irrelevant background noise.
You stop trading the news, and you start compounding wealth.
Finally, we arrive at step number 4. Educate and diversify intelligently.
Now, this raises an important question. The concept of diversification is thrown around constantly in mainstream financial advice, but it is rarely properly defined. How wide should your net actually be?
The source offers a highly pragmatic framework here. Your level of diversification should be inversely proportional to your level of financial education.
Right. That is exactly right. If you are early in your financial journey, and you do not possess the time or the macroeconomic literacy to deeply analyze individual balance sheets or geopolitical supply chains, you should diversify as widely as possible.
You buy the massive, low-cost, broad market index funds so that you own a microscopic fraction of the entire global economy. You guarantee that you will capture the upside of human progress without taking on single company risk.
But as your financial education deepens, as you begin to understand the mechanics of the energy trade, the defense sector contract cycles, and the agricultural bottlenecks, you earn the right to make more concentrated strategic allocations.
However, the cardinal rule of risk management remains absolute. You never go all in on a single thesis.
Right. Confidence is vital, but hubris is fatal in the markets.
You do not allocate 100% of your net worth into a single aerospace contractor just because a war breaks out.
You do not liquidate your entire portfolio to buy digital assets just because you fear capital controls.
And you certainly don't convert your entire life savings into physical gold. The goal is to architect a resilient, multidimensional web of assets.
You hold the liquid cash for your 12-month oxygen supply. You anchor the core of your wealth in broad, productive equity index funds to capture long-term compounding growth.
You tilt a strategic percentage of your portfolio toward the defense, energy, and commodity sectors to actively hedge against inflation and conflict.
And perhaps you allocate a small, speculative slice to alternative digital assets to ensure borderless, non-confiscatable portability in a worst-case tail risk scenario.
It is a portfolio designed not just to survive the shocks, but to actively harvest the volatility.
It is the ultimate expression of financial education translating into financial armor.
Beautifully said.
We have covered an extraordinary amount of ground today, peeling back the layers of how global capital truly operates under duress. Let's do a rapid, high-level recap of the architectural blueprint we just built.
Sounds good.
We began by identifying the root catalyst of crisis economics, the weaponization of energy geography. We mapped how a spike in crude oil compresses corporate margins, acts as a hidden tax on the consumer, and accelerates the inflation treadmill.
We dissected the impossible position of global central banks, analyzing how their aggressive interest rate hikes inevitably trigger the domino sequence from stagflation into corporate contraction and global recession.
We solved the safe haven paradox, moving past the surface-level assumption that gold is invincible, to reveal how a dominant, high-yielding U.S. dollar creates a foreign exchange seesaw that actively suppresses global demand for precious metals.
We pressure-tested the geographic fragility of physical real estate and traditional fiat banking through the multi-millionaire evacuation thought experiment, highlighting the revolutionary borderless utility of decentralized digital assets.
We shattered the myth of waiting for peace, leveraging a century of market data to prove that equities historically bottom out during the war of words and begin their massive 8 to 11% compound rallies the moment the uncertainty of the invasion resolves into measurable reality.
And we internalized the billionaire's playbook, maintaining a strict 6 to 12-month cash oxygen supply while aggressively deploying the rest of your capital into productive, adaptable economic engines, specifically targeting the energy, defense, and agricultural sectors that possess the pricing power to thrive when supply chains fracture.
This has been an incredibly dense, empowering deep dive. If you are listening to this right now and you can feel a fundamental shift in your perspective, that realization that you do not have to be a passive victim of geopolitical forces, that you can actually engineer your portfolio to absorb these shocks and build generational wealth, then we have achieved the core mission of this show. We want to warmly invite you to subscribe to the Wealthnetic channel. We are deeply committed to continuously bringing you these high-level, actionable macroeconomic insights so that you have the tools to protect your family's future in any environment.
And we ask that you actively share this knowledge. If you have colleagues, friends, or family members who are currently paralyzed by the 24-hour news cycle, who are panic selling their retirement accounts, or who are making emotionally driven financial decisions based purely on geopolitical fear, send them this deep dive.
Financial education is the most potent, effective antidote to market panic that exists.
It truly is. It is the definitive line separating those who are merely trying to survive the turbulence from those who are actively architecting their wealth through it.
As we close out today's session, I want to leave you with one final, deeply provocative idea to internalize. We framed this entire discussion around the reality that a small, prepared minority grows their wealth while the majority struggles.
The legendary investor whose framework we utilize today has a defining maxim that perfectly encapsulates the psychological fortitude required to join that minority. He stated, "In times of crisis, cash combined with courage is priceless."
Cash combined with courage. That is an incredible synthesis of mechanics and mindset.
Building the 12-month oxygen fund and understanding the macroeconomic data that provides the mechanical cash preparation. But the courage, The courage is the psychological mastery.
Right.
When the geopolitical world is fracturing, when the media is screaming that the system is collapsing, and when the panicked herd is aggressively liquidating their productive assets for pennies on the dollar, are you mentally prepared to step away from the herd?
Are you prepared to be the one who looks past the immediate terror and recognizes the historic generational opportunity hidden within the crisis?
The theoretical frameworks and the historical data are now fully in your hands.
The chaotic, muddy waters of a global crisis do not have to be a source of financial paralysis. If navigated with education and courage, they can be the exact crucible where you forge your financial independence. Thank you so much for investing your time and joining us on this deep dive. Stay educated, stay calm, stay invested for the long horizon, and we will see you next time.